But let's welcome on board now Maneesh Dangi, macro investor and advisor, right here in the studios. And Maneesh, hi, good morning. Great to
Hi.
see you in person. Just going through your 11th August message, and actually it stood out really. Indian bonds currency move is a little disappointing, didn't rally as much despite clustered good news over the past month. And you're talking about crude, dollar index, US inflation, jobs. You're saying that equity did a good job though, and you still think until winter the long trade may persist, but the frailty of the move thus far suggests that the hangover of fundamentals, which is high current account deficit, high FD, it's not a time to short them yet, but you also said that the next trade to pile on seems that only. Now that the dynamics have completely changed thanks to the Jackson Hole Symposium, I'm guessing you would be going further short.
Yeah, morning, all of you. I agree. Mostly, sort of setup seems that we are in this big range, and you'll have a lot of policy flip flops. Economic data is still fine, but what let's say again, why markets are falling today is largely because markets sort of are now thinking perhaps they misread what Powell said in July.
Yeah.
Or miscommunicated, that Fed did some miscommunication. But I like to see things from the point of view of some sort of inductive reasoning in terms of that whatever market did in last 1 month, that first they rallied and then they're collapsing now, perhaps there is some logic to it in terms of the fact that there is a range of outcomes likely right now. One, and both can be sort of argued fairly ferociously. What I mean to say is that it is possible that inflation may persist, but it's also possible that low growth in China, Europe, and also the signs what's happening in US could mean that inflation actually can go down. So given that both outcomes are now equally likely, what Fed is trying to do, or what in turn markets are interpreting, that let's induce a lot of volatility. So volatility itself sort of becomes, in some sense,
A hedge.
An instrument to express the reality. And the reality is that, well, both day and night are possible. So to that extent, markets, that's what I wrote to you other day, that, markets are going to sort of be in this big range, that every time they get complacent for any side of you, and you will be introduced with the other side, either by policymakers or market themselves because of positioning.
Now, Fed is tightening, but Manish, when Fed was tightening because of an compulsive fear against inflation, it actually started happening in Feb and March.
Yeah.
When they started tightening, the war also happened, right? That added an extra layer, extra dimension of fear. That is not the situation. So while Fed is tightening this time, there is no spike which is expected, at least in oil or energy prices. That makes the template and this time's commentary different. Is that a reasonable assumption?
Firstly, war hasn't gone and wouldn't go away for years
The
to
spike
come.
which came,
I
which
agree.
scared everybody, that may not be at play.
But what war did actually, frankly, there is disaster happening in Europe. But purely from the market's standpoint, what war does is that it introduces an additional layer of volatility and supply constraints at margin. So basically, what we are living, Nikunj, now is that while the demand because of stimulus, because COVID has faded, has recovered pretty much significantly, but supply hasn't recovered. And the key marker to that is, think of, let's say, US, which has done well but is running 5% current account deficit. India is running 3% current account deficit. So these bulges, while the demand has only recovered to the pre-COVID and trajectory, but the current account deficit has bloated, which essentially means that the supply within the country or in aggregate for the world hasn't recovered fully, which is why any country which has recovered is actually showing signs of having large amount of current account deficit. Yeah. Because there's nothing but actually that you can't produce as much that you're actually importing from the rest of the world, right? So I agree that war's first order effects would have faded by now, but the second order of that, along with the geopolitical tension between US and China, what's happening in Taiwan, all of that suggests that these the fears of supply sort of disappearing again and again would stay for very, very long. And my sense is that that would mean that we'll have to live with a shorter, smaller amount of aggregate supply in the world of everything that you can imagine.
Okay. Manish, just picking up on the point that you were making earlier, that what the market is reflecting is volatility because it's working with two scenarios right now. But just directionally, do you think it's time to give up hopes of that recovery that we saw from the June lows, the fact that the Nifty was almost close at an index level to its all-time peak? Do you think that is something we should, completely do away with and not a scenario that we should be working with?
So Aisha, vol essentially in real life terms is uncertainty. So what it tells you is that, that hope isn't the only outcome, but it's not the outcome which, you can sort of say that, no, it's not there at all. So buy is both.
Yeah, exactly.
So basically you get a wave of good data and then you get complacent, implied vols fall, okay, markets rally. And then, something else come, either in terms of economic data or in terms of Fed speech or RBI data, and suddenly you sort of get an impression that the opposite could potentially be true. So you have to literally actually unwind some of the move.
So as an investor, what should be the tactical stance that you need to take so that you don't get caught on the wrong end of either side of the volatility?
Yeah. So if you're a systematic investor, you don't care, right?
Obviously.
Every month you keep putting in money through SIP or dollar cost averaging. If you're a speculator, then you ought to be, clear about this, that you're very likely to get whipsawed if you play momentum. So the reasonable strategy in this setup is contra. That whenever the IVs actually fall, whenever market becomes sort of complacent, actually pile a trade opposite of the market's direction. So that's the speculator's view. If you're an asset allocator, which is actually doing overweight, underweight on bond and equity, I guess it's still time to stay underweight equity, for some time to come until, you have these clouds disappear with respect to, inflation's outcome.
We had an interview just last week with Shaktikanta Das, and he was talking about being very cognizant of the way the rupee is moving and managing inflation. Given that we've seen the US Fed be very candid about cost to the economy, how are you looking at how they're dealing with inflation and how the own Reserve Bank governor has been dealing with the inflation worry back home?
So, look, local inflation, while it's strayed, beyond what is seen appropriate, in the current monetary policy framework. And yet, once you compare this with what's happened in rest of the world, especially developed economies, we've sort of done pretty well. So to that extent, Nikunj was right in actually complimenting him that, in a sense, these guys have
done a good job. Yeah.
They've done a good job in actually not overreacting. In fact, overreacting in the beginning, just in and around COVID in March 2020. And also, unlike Indonesia and many other countries who've been rather late in actually pulling out, they've actually pulled out liquidity, tightened rates. So to that extent, I sort of quite admire this guy, that he's been more pragmatic and, reminds me of, what Reddy used to be back then, So no ideological bias. So going back to inflation argument, actually, India also, because crude has sort of settled, could see that at margin over next 6 months, the first order effect of high WPI should start to fade and CPI should start to go down. But then my worry is, I've argued last time in June also with you that, in the run up to winter, crude would perhaps start to spike again for a variety of reasons that we can discuss. And that would mean that the second order inflation pain would begin again in India.
So let's understand, you said last time when we spoke to you, you said you will cover your shots, right? And that was about 40 days ago.
Yes.
Cover your shots, and then markets rallied after that.
Yes.
What would be a long trade for, let's say, from September to December? Because winter effect would come in. I mean, Aisha would use winter as coming in terminology of Game of Thrones, but I would like to use this in terminology of markets. What would be a long trade and what would be a short trade?
So the typical short trade or long trade would be what played out between October 2021 until June. June end that we discussed, which is macro actually starting to get worse because of high crude prices, emerging market currencies getting gaslighted again, including INR. And while I continue to think that India's setup from a pure macro and its microeconomics actually seem reasonable, and to that extent, Indian equity may not sell off as much, but still, we are more likely to see downsides than upside. So to that extent, be a nuance short on equity as well. I also see that that will be the climax of bond. That in that period is when you will see peak bond yield. Perhaps going all the way to 8%.
So 7.7 was not the top what we saw in June.
It wasn't the top. Because there is far too much fiscal dominance in India. Bonds somehow, from a positioning point of view, because U.S. Treasuries rallied, got a small cushion. I don't think they've peaked yet. So you're more likely to see a peak, more likely in December to March.
When you say underweight equities, are you also tempted to short the index or be or to sell any individual stocks or sectors or be underweight on?
So the underweight is essentially for an asset allocator. So I come from a background of being a public portfolio manager. So invariably you will hear people there where they sort of always asking that at margin, I have 60% equity, 40% debt, what should I do? Because I have to deploy, let's say, $100 more, which can actually take equity position higher or lower. And if you are a status quoist 60-40 guy, then at this point, it means that your equity exposure should be actually somewhat lower. And then what do you do with that money? So ideally, you could say throughout October, November, December 2021 that stay on cash. But because now bonds are fairly attractive, that you can get a 1-year instrument at 6% versus then, which was at 4%.
Yeah.
The 10-year bond, PSU bonds are now trading at about 7.5. I think it makes sense to be at margin adding bonds versus equity. So that's what the complex of underweight equity means.
And how real or how worrying would US recessionary fears be at this point in time, and how do you see the India story or the India dynamic dealing with that?
So US recession is a likely outcome, but it's not a likely outcome in 2023. That's been my view for long. Over next 2 years, yes, you will have some mild recession in US. By the way, US is the cleanest shirt even today, as I've argued on your channel many times. And it continues to do very well. Its employment conditions are in absolutely best of the conditions. And so India actually is one of those very few top 20 countries, which are in good shape right now. Otherwise, Europe is in very bad shape. China is blowing up. Japan actually is very likely to enter in recession yet again. So I wouldn't pile on a trade which actually is predicated on US recession, sharp employment losses, which is what actual recession means, I mean, GDP growth or degrowth is not.
So don't bet against the dollar.
So I have had the similar view that for last 1 year that it's better to err on the side of actually long dollar, even now. Though it is very clear that it's overbought, that it's an extreme valuation versus especially international currencies. So at margin, I think I am more comfortable actually long dollar and short emerging market currencies versus developed market currencies. I think Euro and JPY have already done a good job. I think it's better that we short for local audience. I think INR at margin could actually weaken quite substantially in the run up to winter.
Really appreciate your time. So glad you could join us, and thank you for joining us in person in the studio. So good to have you back after about 2.5 years almost now.
Yeah,
in person.
You.
And is it still long buying farmhouse land?
Yeah, that trade, as I sort of told you, you can't actually size up that trade, but it's done well. It was essentially a proxy of food prices going up, so that the agrarian yield will go up, and so that's what has played out. It's not well documented in India, but you'd be surprised that majority of North Indian West Western farm prices have gone up by 20 to 50%.
Small town,
in last 1 year. Small town prices.
real estate pricing
actually
is up 40,
at time
50%.
if you picked up right places, they've
Where
doubled.
did you buy?
Rajasthan only.
Rajasthan only. Going back to roots.
Okay. No, because managing that is difficult, right?
Yes.
If
Land
you,
is always
in
a
random
low-
place if you buy.
This
Half the
actually
time people are calling, Patwaris are calling that.
every state has a different law and every state has a different procedure in which you actually go through it. But
So buy
good-
what you understand.
exactly. Good luck and thank you for joining us.